Great. So we started recording.
All right. Hello. Welcome to the next workshop. It's financial literacy education organization, and they'll take it from here.
Yeah, first I want to start off by saying thank you to TaroHacks for having us. We're really excited to be here. And yeah, so our workshop today is done by FLEO, and we're a 501c3 student-led nonprofit. And before we start our workshop, we'll just give you guys a bit of information about us. So what is FLEO? So FLEO stands for Financial Literacy Education Organization, and we kind of started out when we realized 66% of Americans are financially illiterate, which means they don't have the basic skills to manage their money and establish their financial freedom. And on a teen standpoint, 52% of teenagers want more financial education, and among the other 48, a lot of them don't even know what financial literacy is. So we kind of started out to bridge that gap between students and financial literacy. And we started after we realized that these core concepts are not taught as much as they should be in schools. We oftentimes we have economics classes and stuff like that, but we don't really have any personal finance classes that are so important for us to be successful later on in life. And yeah, since we started a year and a half ago, we're now in 5 continents. We have 30 members, and to this day, we've impacted more than 3,200 students, and we're hoping we can positively impact you as well. So without further ado, we're gonna teach our workshop about when we're gonna begin with personal finance, and then we're gonna move on to fintech. Given that this is a hackathon, we want to have some STEM focus. So yeah, so we're excited to get started.
So our first topic for today is compounding interest. So compounding is an integral part of business and finance, which are both important to be economically self-sufficient. And although compounding is important, it can both work for you or against you. So let's start off by understanding what compounding is. By definition, it's the process in which an asset's earnings from either capital gain or interest is reinvested in order to generate additional earnings over time. So therefore, it is constructed with an interest rate in mind. It is important to understand the differences between simple interest and compound interest. Simple interest only calculates your money from the original value that you deposit, while compound interest calculates your money based on your most recent value. In other words, simple interest only generates a specific value based on your original amount and the fixed interest rate, whereas compound interest adds the amount based on your most recently compounded value. So it would put an interest on top of the previous interest. An example of this is the math variable e, most commonly seen in exponential graphs. This allows you to increase your profits at a very fast rate. And compounding interest can relate to your everyday lives because, for example, if you want to deposit money in a bank, it's useful to know compound interest to know how your money is going to pile up in the bank and how much you're going to have when you finally take it out. And then it's also commonly used for credit cards and student loans, and all these are able to increase your profits over time, but they can also, but compound interest can also be detrimental to your profits over time. So let's see how we calculate compound interest. We use this formula, A equals P, and in parentheses 1 plus R over N times to the power of N times T. In this equation, A is the final amount, P is the starting amount, R is the interest, N is the number of times you compound, T is the number of years, and this could be annually, which would be 1, semi-annually 2, quarterly 4, and monthly would be 12. With this equation, you can calculate different aspects of your compounding plan just by solving for a variable. And although compounding may seem beneficial for making profits, there are many downsides to it as well. And a quote by Albert Einstein actually sums this up perfectly. Compound interest is the 8th wonder of the world. He who understands it, earns it. He who doesn't, pays it. So just like how your profits can grow very fast, credit card debt and other loans can grow rapidly as well. Credit card debt, if not paid off immediately, could skyrocket just like your profits. With one mistake, you could be swimming in a pool of debt. So one way to avoid this is make sure to pay off all your debt quickly so that you can avoid debt accumulation and compound interest. Let's take a look at some example problems. We're not going to go over these in depth, but we'll just take a quick look. So we have all our variables here. And in this equation, we're solving for the final amount. and that's what you get. In this example, you have the final amount, but you want to know how much you started with. So you plug in all the variables and you get self-repeat.
All right. So as you guys are able to tell, this section is going to be about banking and money management, which is a very essential part of finance and money management. Wait, financial literacy, sorry. Next slide, please. So the goals of this part is to enable viewers and students to create a plan using the tools I provide in order to save up money and allocate it for future use. But ultimately, the main goal of this lesson is to teach viewers and students to become financially responsible and literate. Next slide. So you may be asking yourself, what is money management? Well, when you search up the definition of money management on Google, you get money management is the process of expense tracking, investing, budgeting, banking, and evaluating taxes of one's money, which is also called investment management. Money management is a strategic technique to make money yield the highest interest output value for any amount spent. So as young adults and teens, this may not be very useful without much prior financial knowledge, and you can't really understand what they're trying to tell you. So next slide. So in reality, the true definition of money management is the control of cash flow. It may also be referred to more narrowly as investment management and portfolio management. This will help you avoid a lot of financial problems like wrong investment or credit decisions, and it'll help you reach your financial goals. More importantly, it helps you avoid incurring too much debt in the future. So why am I stressing it so much now? Scientists estimate that 42% of recent pandemic-induced layoffs will result in permanent job loss. And the overall unemployment rate shot to 14.7% in April, the worst figures on record since monthly jobless statistics began to be compiled in 1948. With the second wave coming around, we can only expect these figures to worsen. This means people will be losing their steady source of income that they heavily relied on, and will be forced to make financially educated decisions or risk heading into poverty. Next slide. So the first tool I'm going to be giving you guys today is balance sheets. Balance sheets are used to report a company's or individuals' liabilities, assets, and equity at a certain point in time. As you guys may be able to tell, it's a lot more complicated than you'd expect for a young adult to use. So these are often seen much more in the corporate scene and tracking your family expenses as a whole. And it also tracks the overall net profit and net worth of a person. Next slide. On the other hand, a budgeting plan is a much less cluttered and a simpler, more straightforward tracker. This can be used by young adults in their day-to-day lives in order to track smaller purchases such as food, clothing, gas, etc. It's a great tool that enables you to plan for future expenses and allocate your money to each category ahead of time in order to make smart decisions. Next slide. So now we're talking about debit and credit and accounts, which is very different from debit and credit cards. Credit and debit are two major terms that you'll often see thrown around when using balance sheets. Credit is what you spend, for example, buying groceries, and debit is on the left-hand side, while credit is on the right-hand side. Debiting is gaining wealth or having some sort of monetary income within your account. Example could be perhaps selling a chair for $35. That would be debiting $35. And on the bottom of the slide, you can see your account, and debit is on the left-hand side, like I mentioned, credit on the right-hand side, and the positive minus to represent income and spending. So next slide. So how many of you guys have experience with debit credit cards or know the difference between them, even if you never use them? You just put it in chat if you know. Okay, so Kaylin does. Okay, it just seems that Kaylin's the only one who knows. So it's not very common, but it's actually a great tool to know before you head off to college, because a lot of people, big companies will actually try to give you scams in a sense in order to put you in debt. So debit cards and credit cards are very different from debit and credit when used in balance sheets, as you may know. Debit cards use money directly from your bank account and use an interchange fee like credit cards. Interchange fees are transaction fees that allow the bank to make money off your spending. Debit cards are cheaper as you don't have to pay back money to the bank since you're not borrowing any, and you don't have to pay an interest because, as I mentioned, you're not borrowing anything from the bank. And credit cards, on the other hand, are safer in a sense that they have more security because you're borrowing money from the bank's vast supply of money. And if you lose money somehow on a credit card, it's basically the bank's money, so you're not the one covering it until you pay it back. But they're also very risky in the sense that you have to pay it back with an interest. So you can easily overspend on a credit card without knowing it because you have a sort of unlimited supply of spending. Then again, if you can pay it back, it's extremely beneficial because you can build up your credit score. And a credit score is basically a numerical value for financial firms to decide how reliable you are when they're going to be giving you big loans like house loans, car loans, even student loans. It can show them how reliable you are, and you can get a lower interest rate on your loan. So many people ask, as a student or young adult, would you rather use a debit card or a credit card? As I said, if you can pay back the credit card, it's great to use. But debit cards at our age are a lot safer because parents can control our spending. You won't be spending anything unnecessarily, and you won't have to worry about paying anything back. Yeah. Next slide.
All right, so when we're talking about finance, what comes to mind out of all topics is investment. Investment is one of the most important topics in finance, but also it can be like one of the hardest ones as well. So how does investment work and what is it? First of all, investment is defined as the act of allocating resources, usually money, with expectation of generating an income or profit. There are many ways to invest, from investing into the economy through the stock market or investing into companies through loans. So as of right now, as high school students, what matters to most of us is investing into the economy, which is often through various purchases of bonds and stocks or through various funds. So a bond is a certificate issued by the government or a public company promising to repay borrowed money at a fixed rate of interest at a specific time. And a stock is a security that represents the ownership of a fraction of a corporations. Those two definitions may seem very, very confusing to people without much financial knowledge. If so, you can think of them like this. A bond is a loan that you give to a company that they have to pay back to you with an interest rate, and a stock means that you own a part of that organization that issued it. These two terms are very, very important when it comes to investment, so make sure you don't mix these two terms up. So other than those two concepts, bonds and stocks, there are also something called mutual funds, which are professionally managed investment funds that pools money from many investors to purchase securities. These securities vary depending on the type of fund. Mutual funds can invest in stocks, bonds, cash, and other commodities. Some funds cover multiple categories in order to be more balanced. Next slide, please. Here's a diagram of the various types of mutual funds. Even this diagram doesn't cover everything, so I'm sure you understand how complicated investment can be, right? So some important categories that you want to remember from this diagram are index funds, target date funds, and exchange traded funds. Index funds are portfolios created to imitate the financial market index, such as the S&P 500. They contain stocks from all of the companies in the market index in order to mirror the performance of the economy as a whole. Target date funds are funds that rebalance asset class weights over time so that it becomes heavier to stocks when you're younger and heavier to bonds as you age. So both index funds and target date funds are very important when you start to consider your own retirement. And the last one is exchange traded funds, which are like mutual funds, a collection of securities such as stocks. But exchange traded funds differ with mutual funds in that exchange traded funds are listed on stock and exchange markets throughout the day, while mutual funds are only listed once at the market closure. Next slide. When you invest, like when you eventually invest, you also want to know how safe an investment is. So as a rule of thumb, here's a diagram of the safety levels of various forms of investment. As you can see, individual stocks are the riskiest, but also have the potential for the greatest reward. On the other hand, forms of investment such as saving accounts are the safest, but they have comparatively low reward. We'll answer questions at the end. I want to make sure we can like go through the thing. So if you have any questions that pop up, go ahead and feel free to put them in the chat. We'll try to address them at the end. So what you decide to invest in depends on each person's situation and willingness to risk money. That's a decision you have to make for yourself. Next slide. Now, if you choose to invest in stocks, one really important thing that you want to understand is how to read a stock chart. Shows the history of a company's stock. So pictured here is Apple's stock chart for the past 5 years. The letters on the top left are what is known as a stock ticker. This symbol represents each company, which for this case, Apple is represented by AAPL. The white number in the top right is the current price of each stock, which is pictured to be $318.19. The red number next to it is how much the number has changed since the last market closure. In this application, red means the stock has dropped a certain amount, while green means that the stock has gained a certain amount. The green line is in the middle of the graph is called the trend line. And when looking at the trend line, one thing you want to understand is the time range that you're looking at. A single day, week, or even month is often not enough to tell how a company is doing. So pictured here is Apple stock chart for the past 5 years, which gives us a much better understanding on how Apple's stock history has been doing. So in this picture, Apple stock history has generally had an upward trend, which is really, really good. In addition to that, don't be too worried about sudden drops or gains in the stocks. Many factors can affect stock changes, such as changes in leadership, raises, releases of new products, political events, and more. One current event that's affecting stock markets like a lot right now is the current COVID-19 pandemic, which has greatly dictated the course of the market over the past few months. If you can try to see why the stock prices have changed and you can predict these changes, you'll better be able to predict, control the stock market. So next slide, please. Here's a chart of Tesla stock over the past 5 years. Go ahead and give it a quick glance. Try to see if you can understand it. What's its general trend? Can you think of any reasons why its stock price behaved as such? So go ahead and leave in the chat with any answers you guys might have to why the stock chart is like this. So for the stock chart, one thing that is really obvious is the big drop at the beginning of 2020, which is the COVID-19 pandemic. And the big rise before 2020 can be seen through the release of the Cybertruck and everything like that. All right, so let's move on. Next slide, please. So now this slide is more personalized to you guys. So now that we've gone over the basic concepts of investment, why does investment matter to you? Why should you feel the need to invest at all? So first of all, there are numerous ways to invest. There is certainly a method of investment out there that suits your personal style. People often have a misconception that investment is for rich elites with vast amounts of money to spend, but that is really untrue. Investment is actually very flexible, and it's flexible enough that anyone that wants to get involved in it can. So investment doesn't have to be a risky business if you don't want to. Investment is also a really good way for you to get involved in your own economy. Our economy relies on investment and transactions in order to be stable. By getting involved through investments, you are contributing to the overall stability of the economy. By investing, you can also get involved personally with industries that matter to you. Your investments can help shape the future. In addition, investing early can provide long-term benefits. Planning for the future can be greatly impacted by your investments decisions made early on.
Okay, so, okay, so next we have planning for the future. The next slide. So paying for college. Let's talk about college, which for many of us is in the near future. According to a 2018 report by the Federal Reserve Bank of New York, as many as 44.7 million Americans have student loan debt. In other words, 1 in every 6 people over the age of 18 have student loan debt. In addition, over $1.5 trillion in debt is owed. Now let's go more in depth about what student loans are. Student loans are loans taken by students who are not able to pay for college completely. And like we've already mentioned, students will have to pay it back with an interest. This means you will end up paying the bank more money than you took from them. And with interest rates being over 6%, it's important to not take out more money than is necessary. So what are some ways to lower the overall cost of going to college? One of the easiest ways to reduce the cost is through scholarships, which are financial aid awards designed to help reduce the costs students have to pay for an undergraduate degree. Over $46 billion in scholarships are given out each year. There are many ways to get them. There are 7 common scholarships granted by organizations and colleges, which can be granted through academic achievement, community service, athletic achievement, hobbies and traits, your personal background, if you have financial need, family workplace, or if you have a military affiliation. These scholarships aren't just awarded by the colleges themselves. Some programs and organizations also grant scholarships to students. Organizations can give out scholarships in a number of ways, such as through winning a competition for your personal achievement. One example of this is Coca-Cola, which has given out over $66 million to help students. It's also important to remain frugal while in college, which basically means don't spend a lot of money. This can be achieved by cutting your spending from simple tasks like commuting from place to place to more advanced tasks, so like creating your housing and meal plan for the entire school year. By doing these simple things, you can prevent yourself from getting trapped under a lengthy and expensive loan. Now, let's look at life after college. Next slide, please. Okay, planning for retirement. Although retirement is a long way, I presume, it does not hurt to start learning about it right now. The most common type of retirement plan is a 401k. A 401k is a plan that is normally offered to you by the company you work for. Its goal is to set aside money for retirement, which comes from your paycheck and goes directly into your 401k account. You may ask, why is a 401k account so important? Well, it's important because it helps you save money for retirement and also provides you with benefits along the way. For example, some companies might offer an incentive, such as every dollar you put into your 401k account, the company will match it with 25 cents. Which doesn't sound like much, but another benefit is tax reduction. If you put money into your 401k, then the IRA, which will grant you a tax deduction on your adjusted gross income at the end of the year. Now, let's look at an example of this. Let's say you made $100,000 this year and you put $20,000 of that into your 401k account. At the end of the year, you will only be taxed as if you earned $80,000 that year. So you keep your previous money and you have to pay less taxes. Another bonus about a 401k account is that you can use this money to invest in the stock market or in bonds. By investing in these, you can get up to an 8% return annually. Another common retirement plan is the previously mentioned IRA, which is an individual retirement account that allows an individual to save money for retirement with added bonuses such as free tax growth. And just like the money in your 401k account, the money in IRA accounts can be used to invest in the market. There are 3 types of these plans. The first is a traditional IRA. The benefits of this account are that you can invest in pre-tax dollars or post-tax dollars. However, a limitation of this plan is that you must begin to withdraw your money once you reach your 70s. The second one is a Roth IRA. In this plan, you will be investing after-tax money, or in simpler terms, money that has already been taxed. One reason why this is such a popular type of IRA account is that after the age of 59, withdrawals are tax-free. Not only that, but because the money invested in after-tax money, it will no longer be taxed, meaning you can gain substantial amounts of money by investing it into the market. While this might sound very beneficial to you, there are also some limits of this plan. One limit is that you may start losing the ability to contribute a Roth IRA if you are single and if you earn over $125,000. The last plan is a rollover IRA. In this account, you will invest money that has been rolled over from a qualified retirement account. This means that you can move some or all of your money from a retirement plan into this account. Normally, rollovers occur from a 401k account to an IRA account. As you can see here, a 401k account and an IRA account are both types of long-term savings accounts which lead you to have a constant source of income. And remember, investing is not just about investing in the market, but also in your future. Next slide, please.
All right, guys. So now that we've got kind of a basic understanding of personal finance, we can kind of venture into something that a lot of us might have heard about but not know, or some of us might not have even heard about. So let's talk about fintech. Okay, so as the name suggests, fintech is the intersection of finance and technology. And given that we're at a hackathon, I assume that everyone here is proficient in technology. And with the personal finance lesson the FLEO team just gave, it should help you better understand what the industry of fintech is. Okay, so what is fintech exactly? So you can think of fintech as the automation of financial services. So for example, if you think of going to the bank and depositing a check, in the olden days, we would have to go into the bank with to give the teller at the bank our check, and they have to deposit the money into our account. But today, if we have $20 we want to deposit into a bank, we can just access that $20 from our phone. Same thing, say I want to give Swastik here $20 because he's been a good friend to me. Instead of going to his house, giving him a $20 note, I can take my phone and I can message him, or I can, through an application, I can give him that $20. So all these financial services and processes that we relied on to do interpersonally, we can do this through technology. So it's all these processes, automated, digitized, whatever you want to call it. So let's look at some common examples of fintech, because fintech really is all around us today, even though it's seen as an emerging industry. So the first thing, like I mentioned, online banking. Wells Fargo, Bank of America, all big banks pretty much have their mobile application where you can check your checkings account, your savings account, your transaction history, and you can basically see how much money is in your account, and you can monitor your cards and everything like that. And you can do all of that with the comfort of your phone. The second is payment services. And I think most of us probably use this the most, like Apple Pay, Venmo, PayPal. These are all examples of companies that we can send money like it's a message, like it's like just phone to phone. The third is cryptocurrency. Not a lot. This is more niche. Not a lot of people might have heard of this, but cryptocurrency is basically a decentralized, digitized currency, like the dollar. So if you can think of the US dollar, cryptocurrency is like that, but it's all online. It's not backed by paper notes or backed by gold or anything like that. An example of cryptocurrency is the B logo you see right there for Bitcoin. That's a famous cryptocurrency that was going around. That's still around today. And the reason a lot of people like cryptocurrency, just some added information, is that because it's decentralized, it can't be manipulated by one corporation or one government. It's completely decentralized on the internet, and no one can manipulate it. And the fourth and most common, actually this could be more common than payment services, is GoFundMe, or crowdfunding platforms that allow us to raise money for nonprofits, for hackathons, for all sort of initiatives we want support for. Instead of going door to door saying, hey, can you contribute $20 to my initiative? You can just set up a GoFundMe, write a good description on there, and people can pay right through the website, and that goes straight to your bank account. So these are all examples of fintech around us. So why is fintech important? Like I mentioned, it is a part of our daily lives. So whether we like it or not, it's here. And given the fact that it's one of the fastest growing industries, I'd say it's here to stay. This rapid growth also allows for opportunity, like it does when any industry rapidly grows. And the same here is just some more examples of financial services that have moved online. So that was kind of like a brief rundown of what fintech is. Obviously, there's many avenues we could explore, but given that we're at a hackathon and given that you guys are probably coding your projects, algorithmic trading is the perfect crossroads of finance and technology, and it'll allow us to explore the two in an interesting way. So what is algo trading? Just if anyone could put in the chat, has anyone heard of algo trading, or does anyone do algo trading? Can you guys read the chat to me? I can't see because I'm screen sharing.
So far, no one has really done it.
Okay, so that's, yeah, it's not the most common, but as the name suggests, algo trading is using algorithms to trade stocks. So it's essentially the use of code to execute investment strategies. And before we can better understand algo trading, there's something we should explore, and that is a moving average. So for those who don't know, a moving average is a statistical tool that is a smooth indicator of stock trend based on past data points. So if you look at the graph here on the right, you can see the many fluctuations of the stock market. It's extremely reactive. It can go up, it can go down, and it does so almost every second, every minute. But below that, you can see this smooth line, and that's actually a moving average. And the moving average, what it does is it preserves the trend of the stock market, but makes it easier for calculations because we don't have to account for these wide fluctuations. And something to consider is, naturally, if the amount of days is smaller, then the moving average is more sensitive. So if it's a 20-day period, the events of that day likely have a more impact on the stock, therefore on the moving average. But if it's a 200-day period, the events of the day have less of a bearing on how the moving average results. Okay, and an example of algo trading that might help you guys perceive it better is if the 20-day moving average moves up by X amount of points, then buy 50 shares. So if you program, the first thing that should pop out to you is the if and then. In coding, if statements are one of the biggest things we use. We have the if statement. We have a conditional in the parentheses, and if it meets that conditional, if it proves to be true, then the body of code underneath gets executed. So here, if the 20-day moving average surpasses the X amount of points, the conditional, the input, or whatever you want to call it, if that holds to be true, then the body of code is written in such a way that it'd buy 50 shares of the stock we're talking about. So let's talk about some benefits of algorithmic trading versus manual or discretionary trading. And manual or discretionary trading is something that Joshua was alluding to earlier, which is an individual buying a stock. Like I'm logging into my E-Trade account and I'm purchasing a stock. So that's like an individual just making an individual decision. But algo trading, what it allows us, firstly and most importantly, it eliminates emotion or bias. As humans, we are subject to a lot of psychological and cognitive biases that impact us in ways that we might not even know. And these preconceived notions often impact our decision making and oftentimes make it flawed. So the elimination of emotion and bias, is very valuable with algorithmic trading because there's no decision. All the decisions are made purely logical and analytical rather than being impacted by anything else. Secondly, it allows for constant monitoring, which basically means as an individual, we can probably, if you're not a day trader, which is someone who checks stocks and trades stocks for a living, algo trading allows you to monitor the stock market at all times. Whereas if you're an individual trading, you only have a certain amount of time. You can't look at the market all day. You can only search maybe 3 or 4 times. You can check in and see how your shares are doing. So constant monitoring allows us not only to save time, so we don't have to check it those 3 or 4 times, maybe once, But it also allows us to keep our investment strategies consistent, which means that anytime that something that meets our criteria happens to buy a stock, our algorithm will buy it. Whereas if something happens and we're not monitoring the market at that time, there's a chance that we won't buy that, and it'll reduce the consistency of our strategy. So we won't even know if it's actually working or not. And lastly, it enables the backtesting of strategies. And backtesting basically checks the efficacy or effectiveness of a strategy through the use of historical data. So you can kind of think of this like test code, when you're using test code to see if your program's working, your website's working, your server's working, whatever you've made. Backtesting does the same thing, but instead of writing your own test code, you can use past data points and just plug it in to your algorithm. And overall, it allows us the reduction of human error due to the reliance of code. And oftentimes a lot of people see this as man versus machine, like, okay, machines are better at writing stocks, but it's rather how we can use machines to better leverage our human intelligence to use machines to invest and trade with the maximum success. So there's two main types of algorithms we should discuss. Number one is profit-seeking algorithms, and number two are order-filling algorithms. There are many more types, but these are the most common types you'll see. So as the name suggests, profit-seeking algorithms' main goal is to make money. Your only goal is to make as much money as you possibly can. And examples of profit-seeking algorithms are strategy-driven and predatory algorithms. And an order-filling algorithm, the goal is to buy smaller portions of a larger investment, and that's because you don't want to move the market. So this can sometimes get confusing, so I'm gonna go a little slower and let me know if you have any questions regarding this. Say I'm the CEO of a hedge fund, and a hedge fund is basically a huge pool of money that people invest into, and they make the investment decisions for you. So say I'm the CEO of a hedge fund, and I've decided to invest 1 million shares into Apple stock. I could, and I have the money to do so. I could buy it right away. There's not much of an issue, but the problem with that is that will drive, because it's just such a considerable investment, that would drive the Apple stock price extremely high, right? Because more you invest into a stock, the higher the share price goes. So by investing such a considerable amount into one stock, we're actually driving the price up for ourselves. So if we want to buy Apple stock again in the future, the stock price is going to be higher. Therefore, you're missing out on an opportunity to spend less money than you actually have to. So I would hire someone who can write an order filling algorithm for me and say, hey, instead of buying 1 million shares of Apple in one go, instead buy 50 shares of Apple per day till the 1 million amount is filled up. And what this allows, it allows for two important things. Number one, you don't drive the Apple share price up ridiculously. So not only does that save you money in the long run, but two, that actually allows you to protect your investment strategy. But because you're not buying such a considerable amount of Apple, and you're just buying small amounts, people can't really, it's harder for people to detect what your investment strategy is. Therefore, they can't capitalize of it. And when I say capitalize of it, I'm alluding to predatory algorithms, which is a type of profit-seeking algorithm. And the goal of a predatory algorithm is to look for these large hedge funds, private equity firms that are investing 50 shares of Apple per day. And this predatory algorithm will try to detect, okay, there's this same investment of Apple happening on a daily basis. How can I capitalize of that? So if the predatory algorithm detects that someone is investing on a daily basis, or there's this constant investment in Apple going on for a certain amount of days, the algorithm would detect that and then in turn buy Apple shares. Because if it buys Apple shares, then over time the Apple price will slowly increase because this large investment is going on, and therefore the person with the predatory algorithm is, finding that extra profit. So like it's kind of like a predator looking for that prey to capitalize off of. And examples of order filling algorithms are VWAP, TWAP, and time lapse algorithms, and they're basically just ways to implement large orders to fill up many orders. If you have any questions, let me know, because oftentimes this is kind of a tricky concept because it's intertwined. So if someone from the FLEO team sees any questions, please read it out to me because I can't see the chat. Okay, so let's talk about the steps to algo trading. So the first thing you want to do, like you do with any computer science initiative, venture, program, whatever you want to call it, is you want to formulate your strategy. So like if you're building a website, the first thing you do is you imagine and you design kind of on paper or in your mind, how is this website going to look? So same thing with investment strategies. Before you do anything, you have to think, what am I looking to make money off of? What is my strategy to make the most money? So once you have that in mind, you can go to step 2, which is converting it into code. So you write your program. We'll talk about some languages you could use in the next slide or in a couple slides. But you write your program, you see how, and you tailor it to your strategy so it would work. And then the most important part is number 3. You want to back test your strategy. Like I mentioned, you use past data points to ensure your strategy is working. And this is just a way of making sure that your strategy is rock solid. There's no mistakes, and it's reacting the way you want to. And this is a great place to make tweaks to your program. Number 4, you implement risk management. Examples of that are adding stop losses, limits, and basically the point of this is because you're dealing with money. If your program crashes, you could lose a lot of money. Whereas if your program or website crashes, nothing much really happens. These risk management techniques allow you, if something crazy happens in the stock market that you couldn't account for, or you program something weird happens, this basically protects you from losing a lot of money. Number 5, you simulate with real life data. And this is also known as paper trading. So what simulating with real life data basically means is like you were using past data points in back testing, you're using present day data points when you're using real life data. So you're simulating how your algorithm would do in the market, and there's no money involved. So you can kind of get an idea, again, is my code working? What can I do to make it better? Number 6, you start trading, and you ensure to start slow because, like I'm saying it for the millionth time, money is involved. So you want to be really careful with how you go forward. So you start slow, and then once you see what's working, what's not, you fix it, and then you can scale up and slowly invest more and more money. And just something I forgot to address, a lot of people see algo trading as kind of like a fringe idea that only a few people do, and it's not that common. But the 3 biggest hedge funds in the world actually rely on algo trading for a majority of their strategy. So just to confirm, this is not like a unique idea that very few people engage or take on. It's very common in today's world. And throughout this entire process, you want to test your code and optimize. I'm sure every computer science teacher you've ever met has told you a million times to test your code. And optimizing your code is essentially making your code faster. So you can do this by reducing the amount of lines, using less memory. And optimization is important while algo trading because the faster your program is, the shorter it is, the faster it can run, the faster the trades go through, and therefore you can save cents or a couple cents, maybe a couple dollars, depending on how volatile the stock is. But overall, you're saving more money. So let's talk about some resources for algorithmic trading. So the recommended language among most of the experts and most of the people that do algo trade is Python. And that's primarily because in most of the resources you'll find available for free, they do use Python. But alternatives include C++, C#, and Java. But if you know any of those 3 languages, I'm sure it's not that hard to switch over to Python if you choose to. And the resources that I recommend are Quantopian, QuantConnect, and QuantRocket. And they're 3 really good platforms because 1, they all allow for backtesting. Again, backtesting is using past data points to test your code. And so here, backtesting is really great to have on your platform because you don't have to find your own data, write your own data, or like find these complicated data sets that you don't know if they're reliable or not. You can basically use the platform's feature of backtesting right where you write your code. So that's really beneficial. 2, like I mentioned, they're all Python based. So if you know Python, you can choose any of them. It allows for that flexibility. And 3, it looks like it got a little bit cut off, but it says live trading simulations. So it allows you to also, again, test your code with the real life market. And a lot of these simulations are actually competitions held by private equity firms and hedge funds. And you can win a lot of money if you come first place. So basically you're investing with fake money to win real money. So if you're not too kicked about putting your own money with your algorithm, it's a great idea to do these live trading simulations. And all in all, algo trading is a great way not only to enhance your programming skills and to better understand your finance skills. It's a lot of fun because oftentimes when we write code, we don't actually see the benefit of it. We don't see like it actually doing something meaningful. But here it's it's really cool that you can see your money in action. And even if you don't choose to do your money, you can see your fake money or whatever it is grow, decline, and learn, keep learning. So yeah, now's a great time for questions. We'd be happy to take or answer any questions that anyone might have. We did a lot of talking. We talked about a lot of crazy things. So let us know if there's anything we can answer. Was there a question to be answered from earlier? I remember.
Yeah. Regarding the question that Kavi said, can you explain how stocks and trading stocks work? So a stock's price basically changes as people in the stock exchange market value the stock, like the how much they value the stock changes over time, right? So if more people think that a stock is worth more, the stock prices increase as a result. Tejas, do you want to add on to that? Or?
Yeah, for sure. So that's a great question. So stocks are essentially, you can think of it the more that someone invests in a stock, like if more people invest in a stock, the higher the stock price will be. And that's because you're giving more money to the organization. So that's why a lot of times, and people don't elaborate this enough, I feel like the market is extremely reactionary. So if one thing that might not seem to be extremely important happens, it could have a big impact on the stock. And a great and humorous example of this is actually when Elon Musk, the CEO of Tesla, went on the Joe Rogan podcast, and he smoked weed with Joe Rogan. The Tesla price actually dropped quite a significant amount. And so like Josh mentioned, I think also on the slides, like changes of leadership, earnings reports, there's so many things that affect stocks. Even political events like COVID-19 is not political, but that's another event that's impacted a lot of stocks. When the vaccine was announced for the first time, that actually caused a lot of stocks to increase as well. Some other examples include, and again, I reference Elon Musk because he's doing things that not many other people do. He once tweeted that I think the Tesla stock price is too high or something like that, and then the stock price dropped. So like there's a lot of things that can make the stock price go down, but it's overall it's the optimism of the investors, right? How good do you feel about this company? So the more that people invest into a stock, the higher it goes. And it kind of balances out because if not everybody invests in the same stock, because the more that someone invests, since the price goes up, it makes it people think twice about investing on a higher share price. So that's why a lot of people look and try to analyze the market and are in the news and like our society to see what's the next big thing, what's something that's going to affect stock prices, and then they can get in on it early. And then when the stock price goes up, they can make really great profit margins. Are there any other questions we could answer?
Yeah, we have quite a few in the chat. So let's start with the first one from Caitlin. What's the biggest point you want people to take away from the presentation?
Okay. Oh yeah. Should we answer that? We can go.
Yeah.
I'd say there's a lot of big points, but I would say, of course, we gave a financial literacy lesson and fintech lesson, but I'd say the biggest takeaway is that schools, society as a whole, it's financial literacy education is not as available as we think, but it's way more significant than we realize. So if there's one takeaway, is that like this stuff is like really important, and we wouldn't have like started this whole organization just around it if it wasn't. All around the world, other than like a few countries, like a couple Scandinavian countries, financial literacy is like pretty low, and the lack of financial literacy rather is the greatest cause of cyclical poverty and homelessness. So there's really serious consequences for not knowing these seemingly basic skills. So the biggest takeaway would be always look to enhance your financial literacy skills. And I think the next slide we'll talk about some resources we can provide you guys, or some resources our partners or whoever can provide you guys, and something that could help you guys further your financial education. But the biggest takeaway is like this stuff is so important. and really like apply yourself when it comes to like these kind of things.
Yeah, and one thing I want to add on to that is there's a quote one of our advisors actually gave us. It's, in America, you buy things you don't need with money you don't have to impress people you don't know. And it's just a good thing to keep that quote in the back of your head whenever you're thinking about buying something. Ask yourself, do you have the money to buy it? And like have the money just to, in case something else happens in the future. Would you rather be prepared for that? Or would you rather buy something that's not necessarily useful? I mean, if it is, you can go ahead, but just ask yourself those questions before you make decisions. Yeah. And the resources, we can go over those, Tejas, on the next slide.
Yeah, so we have a lot of resources we like to provide the people that come to our workshops. Like I mentioned in the beginning, we've had the privilege of reaching more than 3,000 students around the world and from 5 different continents, 16 different countries. And we offer everybody the same thing, and we've been getting great responses. So the first thing we have is we have a shared Google Drive, and that Google Drive has a couple of basic things. It has some budgeting plans that's already formatted for you, so you can just plug in the stuff you want to. You can get some practice with that. We're also going to add, it's not there in there yet, but we're also going to add links to stock trading competitions we're going to have, just to get people more engaged with the stock market from an earlier age.